In this lecture, we're going to start off by looking at the advantages and then the disadvantages of floating exchange rate systems. Now, regarding the advantages of floating exchange rate systems, those advantages are actually disadvantages of fixed exchange rate systems. And the reason for that is because floating exchange rates and fixed exchange rates are polar opposites. Those two systems are polar opposites. So whereas a floating exchange rate system has the advantage of having independent monetary policy, a fixed exchange rate system has a disadvantage of not having independent monetary policy. So hopefully that makes sense, and you can. What we'll be doing is just going through the advantages and disadvantages of floating exchange rate systems, but for the fixed exchange rate systems, it's just the opposite, like I just explained. So let's work our way through this and explain the main advantages of floating exchange rate systems. The first one is independent monetary policy, and what that means is that under a floating exchange rate system, monetary policy is independent of the exchange rate, and so therefore it can be used to target low inflation. Another way of thinking about that is with floating exchange rates, monetary policy doesn't have to worry about the exchange rate. The exchange rate can move to whatever level it wants to, and monetary policy can be used to move interest rates up and down without worrying about the effect of those interest rate changes on the exchange rate, and interest rates can be moved up and down to focus on keeping inflation low. So with independent monetary policy is independent under a floating exchange rate system because every time interest rates move up and down to counter inflation, money will either move in or out of the domestic economy. So if interest rates are moved up, money will flow in. If interest rates are moved down, money will flow out of the economy. And that inflow or outflow of money, depending upon whether interest rates go up or down, will change the exchange rate. Now, under a floating exchange rate system, that's not a problem. But under a fixed exchange rate system, there is a lack of independent monetary policy. So with a fixed exchange rate system, interest rates are not free to move up and down to control inflation. Interest rates have actually got to move up and down to help keep the exchange rate at the fixed level. So that's sort of a disadvantage of a fixed exchange rate system, in that interest rates are not free to target low inflation. They have to actually target the exchange rate. The next advantage of a floating exchange rate system is it acts as a bit of a shock absorber. Now, let's just imagine that the Australian economy goes into a downturn. We have a floating exchange rate system in Australia, but the economy goes into a downturn. The first couple of things that are going to happen in sort of a financial and macroeconomic sense is that less money will be flowing into Australia's stock markets, less investment money, because stock returns are likely to be lower during an economic downturn. And also there will be less demand for foreign funding of Australian investment, because investment will fall as well. So the impact that this has on the Australian dollar is when the Australian economy goes into a downturn, because less money flows into the Australian economy from overseas sources, the value of the Australian dollar falls. Now, as the Australian dollar falls, it means that the foreign price of Australian exports decreases, and so that drop in the value of the Australian dollar when we're in a recession means that exports become cheaper and the Australian economy can export more. At the same time, when the economy goes into a downturn and the value of the Australian dollar drops, import prices go up, so Australians tend to import less and spend more of their money on domestic goods and services because they're relatively cheaper. So when an economy is in a downturn and its exchange rate drops, that is really a shock absorber, because that drop in the exchange rate helps boost both foreign spending on Australian exports and shifts domestic spending away from imported goods because they're more expensive and towards relatively cheaper domestic goods. Now with a fixed exchange rate system, that shock absorber isn't available. Number 3, there's no need for foreign exchange reserves. Very often to keep exchange rates fixed under a fixed regime, the central bank or the currency board needs to hold large holdings of foreign exchange reserves so that they can use those foreign exchange reserves, for example, to purchase their own currency in the foreign exchange market when there's downward pressure on their own currency. And that will then support the value of that country's exchange rate and help it keep the exchange rate fixed. Now those foreign exchange reserves, which are primarily used to buy back your own currency when it comes under downward pressure, in a fixed exchange rate environment, those foreign exchange reserves aren't required, obviously, in a floating exchange rate system. So the central bank doesn't need to hold large holdings of foreign exchange reserves. And that's just more convenient for the central bank. It makes life easier for the central bank if they don't have to hold those large foreign exchange reserves. Foreign exchange reserves may sound like a good thing to have. It may sound like a good thing to have $1 trillion worth of assets denominated in US dollars, for example. But what happens if the value of the US dollar drops by 20%? All of a sudden you've taken a $200 billion loss on your $1 trillion of foreign exchange reserves. So if holding foreign exchange reserve, you are exposed to downward movements in the value of the currency that you're holding those reserves in. So it is risky to hold large foreign exchange reserves. Number 3, no need for central bank intervention. We've already spoken about that, but it's sort of warrants being its own point. Central bank can simply remove its or focus less on the value of its exchange rate and focus more on targeting low inflation. And number 5, sometimes under fixed exchange rate regimes, and China's a great example of this, governments will actually restrict the flow of money in and out of the economy to take pressure off the exchange rate. So if a lot of money flows in to an economy, it's going to put upward pressure on the exchange rate. If money flows out, it's going to put downward pressure on the exchange rate. If you prevent money moving in and out through capital restrictions, like in point 5, then you're removing a lot of the upward and downward pressure that can be placed on your exchange rate. So under a floating exchange rate system, there's no need to think about having to restrict capital flows. So in terms of how fixed exchange rate systems are managed, if we go back up here, we had 2 on this slide. Fixed exchange rate systems, the value of the exchange rate can be kept at the fixed level through interest rate adjustments. It can be kept at the fixed level through buying and selling of foreign exchange in the Forex market, and now we have a third one. That is, sometimes, in some countries in the past, capital restrictions have been put in place to help control the value of that fixed exchange rate as well. So that's the advantages. What about the disadvantages? Well, first of all, inflation, deflation is a large one. Now this is particularly relevant in small open economies that are heavily reliant on importing and exporting, such as Hong Kong and Singapore. They are perfect examples. Small open economies. Open economy, the open economy nature of Singapore means that imports are a big part of the domestic economy. So in Singapore, roughly 50 cents in every dollar is spent on imported goods. In Australia's case, that number is sort of around 15%. So imports are much less important in Australia. So in that sense, Singapore is open. It is very reliant on imports. Now, if the Singaporean dollar was allowed to freely float, we know it's not. We know it's targeted within an upper and lower band. But if it was free to float, then large appreciations of the Singaporean dollar would cause import prices to fall substantially. Okay, and so that could then, if the appreciation was large enough, lead to deflation in import prices, and that deflation, if it was large enough, could lead to deflation overall eventually. On the other side of the coin, if the Singaporean dollar was allowed to float freely and there was a large depreciation, that would flow through and increase import prices, and if import price increases were large enough, it could lead to inflationary problems. Number 2, disadvantage. There's uncertainty and hedging costs associated with floating exchange rates. There's not too much in that you need to know, apart from the fact that exchange rates moving up and down make it actually difficult for businesses to plan long term, and or they have to go out and actually hedge some of that exchange rate risk. We're not going to go into that area any further than that in this course. And then number 3, sometimes floating exchange rates can actually make situations worse. So an example of that, and there's only a small number of examples of this, because normally a floating exchange rate will provide a bit of a buffer against economic downturns, as we went through before. However, in this scenario, I've got a country experiencing very high inflation. Very high inflation means that there is a sign of macroeconomic, or high inflation is a sign of macroeconomic problems in an economy, and that is an economy that international investors are likely to want to avoid. So if there is an outbreak of high inflation in the country, it is likely that international investors will actually move their money out of that economy or avoid putting it in there in the first place. That will depreciate the exchange rate of that country experiencing the high inflation, and that depreciation could then create additional import price inflation, which could add to the high inflation that already existed. So they are the main advantages and disadvantages of floating exchange rate systems. Next thing we've got to do is understand that a fixed exchange rate system actually creates monetary discipline. So to set up this example, let's just run with the scenario that Australia is a small developing economy and Australia is fixing its exchange rate against the US dollar, and the fixed rate is 0.7. And let's also assume that Australia, this small developing economy, has had problems with high inflation in the past, and it's had problems more generally with the implementation of monetary policy. So we've got to understand how this fixed exchange rate environment can actually help create monetary discipline in Australia, this country which has a history of very bad monetary policy decisions, i.e. allowing inflation to get out of control and not using monetary policy to keep inflation under control. So how does this work? How does it create monetary discipline? The first point here is that interest rates are not substantially different from the interest rates that are not substantially different from the US are not possible. So if we have a fixed exchange rate system, the idea is, and Australia is fixed against the US dollar, the idea is if interest rates in the US are roughly 4%, they've got to be roughly 4% in Australia as well. Now that's a little bit of an oversimplification. They could be a little bit different from 4%, but they certainly couldn't be 9% and they certainly couldn't be 1%. If interest rates in the United States were 4% and they were 9% in Australia, then that would cause a flood of money coming into Australia trying to earn that higher interest rate, and that would put upward pressure on the value of this exchange rate, and it would make it almost impossible for the central bank to keep the exchange rate fixed. On the flip side, if interest rates in the United States are 4%, but the central bank in Australia cut them to 1%, you would have money not coming into Australia because the interest rates are too low. That would decrease the demand for the Australian dollar in this diagram, shift the demand curve to the left, and put too much downward pressure on the value of the Australian dollar. So if we fix our exchange rate to the US, effectively what that means is we have to keep interest rates in Australia very close to what they are in the United States. And to the extent that interest rates in the US are set at sensible levels, i.e. not 1%, not 9%, then that is a good thing. point number 2 is that growth in the money supply cannot be substantially different in Australia to that in the US. Now once again, to the extent that the Federal Reserve in the US grows the money supply at a sensible rate, a rate which is consistent with long-term economic growth and macroeconomic health, then that is a good thing if Australia is increasing its money supply at a similar rate. So this really prevents Australia from growing its money supply substantially faster or substantially slower than the money supply growth rate in the United States. So we have that monetary discipline imposed on us through the fixed exchange rate system. So we have to match the money supply growth in the United States. What happens if we don't? What happens if America increases its money supply growth at an average level of 4% over the business cycle, but in Australia we grow our money supply by, say, 10% per year? What's going to happen? Well, if we're growing our money supply by 10% per year in Australia, that is going to cause inflation. And from earlier on in this slide pack, we know that higher inflation in Australia is going to cause the Australian dollar to depreciate. But we can't have that because that will then threaten to break the fixed exchange rate. So to keep the exchange rate fixed, we need, in Australia, inflation rates that are similar to inflation rates in the United States. And the only way we can have inflation rates similar in Australia to that in the United States is if we have the money supply growing at close to the same rate as well. So in that sense, having a fixed exchange rate system creates monetary discipline, and in a sense you have to adopt the monetary policy of the country that you are fixing your exchange rate against. And that is why a lot of developing countries over the years have actually fixed their exchange rates against the currencies of more developed, stable economies. It also sends a signal to the market that you are willing to undertake monetary discipline as a developing economy if you fix against, say, the US dollar. It's sending a very powerful signal to the market that monetary policy will be used in a sensible way to keep the exchange rate fixed. Okay, next, the Hong Kong situation. Now, I've provided you with some information on, or some readings on the Hong Kong dollar, so you need to do a little bit of your own reading on Hong Kong's fixed exchange rate system. But what I'll do in this slide is just go through the situation again. So what we've got is Hong Kong dollar being fixed against the US dollar, and the exchange rate's about 7.8 Hong Kong dollars for every one US dollar. So the way it works is that every time there is an increase in the demand for the Hong Kong dollar, the Currency Board of Hong Kong, which is the organisation which is made responsible for keeping the exchange rate fixed, they have to enter the forex market and increase the supply to match the increase in demand. Now, when they actually increase the supply of Hong Kong dollars, they are in the foreign exchange market, they're effectively swapping those Hong Kong dollars for foreign exchange, US dollars or yen. So by satisfying an increase in the demand for the Hong Kong dollar in the forex market, the Hong Kong Currency Board is effectively supplying their own currency and at the same time therefore building up their reserves of foreign currency. Now, as they supply more money into the foreign exchange market, as they shift the supply curve to the right, that is going to increase the monetary base, or the amount of money in the Hong Kong economy, which is going to put downward pressure on domestic interest rates. Okay, what we've got now is a situation where international investors start to move their money out of the Hong Kong economy. So let's just focus on the demand curve and the supply curve that intersects at 0.78. We'll ignore the supply curve on the left. Now, if foreign investors, and this is a major problem with fixed exchange rate systems, they can come under international attack. they can be subject to what we call a currency crisis. So we start off with the demand curve and the supply curve to the right, which intersect at 0.78. So the exchange rate is fixed. And now, for whatever reason, international investors panic about the macroeconomic situation of Hong Kong. What's then going to happen is they are going to move their money out of Hong Kong. So they're going to sell their real estate, their bonds and their shares. They're going to take those Hong Kong dollars, move it through the foreign exchange market and into another country to keep it safe in another country. As they take their Hong Kong dollars and move it through the foreign exchange market, that is going to shift the supply curve of the Hong Kong dollars in the forex market to the right, placing downward pressure on the value of the Hong Kong dollar. Now that downward pressure must be combated, and it will be combated by the currency board, and they will typically combat this increase in supply by increasing the demand for the Hong Kong dollar. So shifting the demand curve to the right as the supply curve is shifting to the right so that the exchange rate remains at 7.8. So how can the currency board shift the demand curve for the Hong Kong dollar to the right? Well, obviously they must go into the foreign exchange market and buy their own currency, buy Hong Kong dollars. But they must have something, they need something to buy them with. And what they'll buy them with is foreign exchange reserves. So in Hong Kong, they actually have all of their monetary base backed by an equivalent amount of foreign exchange reserves. And that's really just giving international investors and everyone internationally confidence that the currency board can swap every single Hong Kong dollar for an equivalent amount of foreign exchange. So it's really just giving international investors certainty in this fixed exchange rate system. So I'll just go through this again. If there is a major run on the Hong Kong dollar, the supply curve shifts to the right as people move their move their money out of Hong Kong. The supply curve shifts to the right. The currency board then needs to step in and shift the demand curve to the right by an equal amount to keep the exchange rate fixed at 0.78. Okay, the next thing, and down the bottom I've got a link here which is for a publication at the Monetary Authority of Singapore. They call it their Explorer series, and this talks about how monetary policy operates in Singapore, but monetary policy actually operates to keep the Singaporean dollar fixed in value. So in Singapore, they have an upper and a lower target band for their exchange rate, and the exchange rate is measured against a basket of foreign currencies, a weighted basket of foreign currencies. So it's not the Singapore dollar versus the US dollar or the Singapore dollar versus the yen or the euro. It's the Singapore dollar versus a weighted average basket of foreign currencies. And so the Singapore dollar is allowed to fluctuate up and down in between this upper and lower band. But the upper and lower band does move over time. It changes over time based upon the inflation objectives of the Monetary Authority of Singapore. But the upper and lower band are not announced by the Monetary Authority of Singapore. The reason being is that if the market knew where the lower bound was and the Singapore dollar actually started moving down towards that band, then people would actually start anticipating intervention by the Monetary Authority of Singapore, which is Singapore's central bank, and that would then, traders would then get involved, anticipating intervention by the Monetary Authority of Singapore, and it would just create a little bit too much volatility in the marketplace if traders were trying to preempt or anticipate MAS moves in the foreign exchange market. Now, keeping this exchange rate between this upper and lower band over time is monetary policy, because the tools of monetary policy will be used to achieve this objective of keeping the exchange rate within this upper and lower band. So, for example, every time there is an increase in the demand for the Singaporean dollar and the exchange rate moves up towards this upper band, the Singaporean Monetary Authority will either lower interest rates or supply more of their own currency in the foreign exchange market, and then those extra Singaporean dollars will move back into the Singaporean economy, putting downward pressure on interest rates. So whether they actually lower interest rates in response to an increase in the demand in this diagram, or increase the supply of Sing dollars in the foreign exchange market, both of those actions by the Monetary Authority of Singapore are classified as a type of monetary policy. So what we're seeing here is monetary policy is used to keep the exchange rate stable. Now, what Singapore's monetary policy and Australia's monetary policy have in common, however, is that they both aim to keep inflation low. It's just that in Australia we keep inflation low through changes in interest rates controlling the overall level of spending and therefore keeping inflation under control. In Singapore they use interest rates to keep the exchange rate relatively stable, and that then keeps inflation under control. Now, the mechanism through which exchange rate stability keeps inflation under control is through avoiding wild swings in the exchange rate. So let's just imagine that the Singapore dollar is set at this equilibrium level, that's where it is today, and all of a sudden the Singaporean dollar was allowed to appreciate by 40%. Maybe it was an increase in demand or a decrease in supply, it doesn't matter. The exchange rate is allowed to go up by 40%, and that breaks the upper band. What would happen? And this is to demonstrate why the MAS wouldn't allow this to happen, because the consequences are quite damaging. So if the exchange rate was allowed to appreciate by 40%, which it never would actually be allowed to do, that would decrease import prices by roughly 40%. And because imports are about half of the Singaporean economy in terms of domestic spending, that would lead to very strong deflationary pressure. So if you allow the exchange rate to go up, you've got deflationary pressure, and that is not consistent with low, stable inflation. At the same time, if the Singaporean dollar dropped by 40%, import prices would go up by 40%, and chances are there would be a lot of inflationary pressures, and that is not consistent with low, stable inflation either. So by keeping the exchange rate relatively constant and avoiding wild swings, Singapore can avoid wild swings in import prices, and in that sense keep inflation low. So this is an example of a managed exchange rate system, sort of part way between a fixed system and a floating system. Now, once again, even under a managed exchange rate system, it does mean that you lose some degree of monetary policy autonomy. So what I've got in this diagram is the Singapore interbank offer rate, which is a 3-month interest rate in Singapore, and the 3-month domestic interbank rate in the United States. So interest rates in the US and Singapore. And what you can see is that these interest rates really do move quite closely together over time, indicating that Singapore does not have complete independence of interest rates to keep inflation low. Interest rates need to move to wherever they need to move to keep the exchange rate within the upper and lower band. So we do see gaps opening up here. In the mid-1990s, interest rates in Singapore looked to be about 3% higher than interest rates in the United States. But that gap over that time would have been consistent with keeping the exchange rate between that upper and lower band. So it's not that interest rates in Singapore and the United States have to move one for one over time. It's more that interest rates in Singapore need to move to a level to keep the exchange rate within that upper and lower band. Now, sometimes that can mean a positive gap opening up over the United States, sometimes a negative gap. It's just that domestic interest rates in Singapore are restricted. They're not free to move. They have to constantly be moving to levels which are consistent with exchange rate stability. Okay, the next thing that we're going to look at in this topic is the euro, and ask the question, should the euro have ever been created in the first place, or was it a giant mistake? and we'll do that in the next recording.